All right, welcome. It's episode 11 of The Rent Roll, your podcast on all things rental housing. I'm your host, Jay Parsons, and we'll be talking about the institutional buy box for affordable housing. We're having that conversation with Alecia Hill, VP for Impact Investing at FCP, also known as Federal Capital Partners. She's one of the foremost experts in this topic, so that's going to be a good one. Before we do, though, we'll dive into the usual review of the headlines and some charts and some other news, and of course, rental housing trivia. So stay with us for that. First and foremost, thank you to our sponsor, Madera Residential. Check them out at maderaresidential.com. All right, so here's a chart. Start off every show with the charts, and I know many of you can't see these things, so I try to walk you through it and what it's showing you. This first one's an update, something I've talked about a lot. Multifamily starts trailing completions at an historic pace in 2024. This might be the most requested chart I do every month or so. And what it shows is the gap between starts and completions year to date. Looking back at every year that the census has tracked this since 1968. So the October data is now out. That gap is now at 218,500 units. In other words, we have completed 218,500 more units than we've started, which of course means that we're delivering a lot right now, but that points to a lot less going forward, especially by 26. And so this is continuing the trend we've talked about previously. Nothing new here, but just still seeing more of the same. So the only period we saw anything else like this was back in the mid 1970s. So it's been a long time since we've seen this fast of a drop-off in supply. Next thing I want to talk about is the declining number of low rent units. And so we've talked previously about this, but there's a filtering process happening today where we build new higher end apartments that's pulling upper income households out of the more moderately priced rentals into the newer, more expensive ones, opening up availability at the moderate and lower rent price points. That is a phenomenally effective way to improve affordable housing supply, but it's not the only way. And so because of that, we still see some challenges and just a severe shortage of the number of lower rent units. In fact, I really should just say that because it's what pencils out today, it's going to be a lot more expensive. It's very difficult to build, particularly for lower income households. So the Harvard Center for Joint Housing Studies has a great chart using census data showing the declining number of lower rent units. And so you look over the last decade, we've done a good job adding these higher rent units, but we've lost the ultra lower rent units. And so these are particularly those that are below, call it $800 a month. That's just a tough price point at which even to operate. And it's maybe even below, what we can really impact in the short term around filtering, just because, again, these are very, very low rental rates. And so what's happening there is just, again, it's very difficult to build at those levels. It's hard to maintain at those levels. And so we are losing at the supply at the lowest rent level properties. Now, again, as we think about affordable housing, the lack of affordable housing, I always like to remind people that affordability is a bifurcated topic. And so I've got another chart here that I've shown previously. This is showing you the rent income ratios for institutions and private and publicly traded REITs versus the broader population, the U.S. Census. So I'd like to remind people that, again, we're talking about affordable housing today, the lack of lower rent units. Let's not confuse the issue, right? We don't really see affordability challenge at the top of the market where we see, generally a lot of institutional capital and private capital focused on. It really is at the lower end of the market, what tends to be less institutional. So nationally, the census data shows 31% of income spent on rent. That's about the same in the last 10 years, by the way. But you look at the SFR and apartment REITs, you look at data from RealPage set of market rate apartment renters, and they're all right around the 20%, low 20s% on rent income ratios. Invitation Homes and Camden are actually a little bit below 20%. So a very good sign on affordability at the top of the market. But again, we need to also focus on the lower end of the market. And so we're seeing more institutional investment of late and focus on how could we make an impact at the affordable levels and do so in a way that's socially responsible and impactful, but also driving a return for investors. And there has been increasingly seeing ways to make that a win-win. I've talked about this on previous episodes. I'll get into that more, but it's also part of the conversation I'll be having today with Alecia. All right, rental housing trivia. This week's question is, how many affordable housing units have expiring tax credits between now and 2030? Is it A, 152,000, B, 252,000, C, 352,000, or D, 1,520,000? So give that some thought. We'll answer that in a bit. Next up, in the news. All right, so this is when we review headlines that touch on rental housing. Got a couple today. The first one comes from Arlington, Virginia. It's from a local media outlet there. The headline is, "Request to study rent stabilization goes to county board." And this is just recently happened. It says, it's, again, Arlington, Northern Virginia, suburb of D.C. Read a little from the article here. It says, the vice chair of the Arlington Housing Commission on November 16th, asked county board members to direct staff to look at the pros and cons of such a policy, not rent stabilization, one that is related to but distinct from full-blown rent control. And let me stop right there. I always love when people try to distinguish between rent stabilization and rent control. We could call them different things. It's still the same idea. It's just, you're just using a different name. Let me read on here. Rent stabilization policies can be implemented many, many ways. This is the vice chair of the Arlington Housing Commission talking, and she's acknowledging that not all, the article says she acknowledges that not all prove successful over time. Stating the obvious there. So here we go again, trying to reinvent the wheel, rent control, rent stabilization, whatever you want to call it. This is one of the most studied policies in the world, and certainly in the US. Ample research. And it's always showing us the same thing, which is that it tends to backfire in the long run, the very people it's trying to protect. Now, there could be obviously benefits for those who are staying long-term in the same units, but it comes at a great expense to all future renters, especially lower and moderate income renters who are then not able to find affordable places to live. Newer renters are then subsidizing units for everybody else. And so it's tempting to think, this time will be different, or, we haven't tried this flavor before, but let's stop kidding ourselves. It's like earnestly trying to make the case that soda is healthy. It just doesn't work. So let's focus on what does work, and that is to build more housing. All right, next headline comes from the New York Times, the guest essay. It's titled, "Climate Change Should Make You Rethink Home Ownership." And this is written by Benjamin Keyes, an economist and professor of real estate and finance at the Wharton School at the University of Pennsylvania. So this is an interesting read. It came out actually about a month ago now. And let me read a little bit from it. It says, as insurance premiums and property taxes rise and future home values grow more uncertain, it's time for some prospective buyers set on living in areas with high risk of hurricanes, floods, wildfires, and tornadoes to reconsider homeownership as a financial goal. Renting is quickly becoming a better way for many people to enjoy these places with much less financial baggage. So the article says homeowners insurance is up 52% since 2019. And it says that being a renter might sound like a step backward to some, like a return to your 20s and 30s. But in this case, it may be worth trading some control for reduced exposure and greater flexibility. A new American dream of renting property near the water. Imagine that. So anyway, interesting think piece. I don't know if I necessarily agree with all the conclusions here. I tell people all the time, we're still a nation of homeowners. That's the American dream. 2/3 of American households are homeowners. I don't think that's materially going to change. I think we're always going to be trying to prop up homeownership in the U.S. So I don't think climate change is going to be a real needle mover on homeownership. But more broadly, I do want to say this, though, with this caveat, it does fit kind of in the broader theme of renting as a lifestyle choice, especially if you want to live in pricey neighborhoods like we were talking about here, waterfront locations where you couldn't necessarily be a buyer. And so if your preference is lifestyle and location over home ownership, then obviously this can play into that, because it's only getting more expensive, obviously, to own in these locations, which of course rental housing operators know as well, because insurance has gone up dramatically for apartment and SFR owners also. Next up, good question. All right, so this is where we answer a question that comes across from social media or other channels. And this was a question related to an article I'd written recently about the preservation of affordable housing. And I tried to make the case that, hey, it's not just about preserving the rent affordability levels of affordable housing. It's also about preserving the physical integrity of these buildings. We can't lose sight of that because these buildings are, in many cases, 30, 40, 50 years old, and they have a lot of deferred maintenance. And so we can't just preserve the rent and then let the properties deteriorate. We got to maintain the properties and maintain the rent levels, but it takes public-private partnerships in many cases to do that. It's expensive to maintain old buildings. And so I got a good comment here over LinkedIn, and it's asking my perspective on workforce housing programs that preserve affordability by restricting rents in exchange for property tax exemptions or bonds. It notes that Texas is leading the way in this effort, notes HFC, PHA, PFC. And the comment here is, although these programs have been and are being targeted by NIMBY politicians on both sides of the aisle, they do provide material public benefits, and asking my take on this. So I'll tell you, I'm here in Texas, and so we've seen firsthand this. I think it's well worded here, kind of a bipartisan effort to really cut back on what they would call the developer or investor giveaways. But I think it's a very cynical way of looking at it. I mean, obviously, you always want to, if there's issues of abuse, obviously you want to address that. But I think there's a fine line at which you cross, which the programs are no longer impactful to their primary cause, right? Which is preserving or creating new middle income or lower income housing. And I think Texas is unfortunately maybe going to be heading that direction if we're not careful. And so at the end of the day, there's a reason we create incentives. We create an incentive of the private sector for a public need, in this case, affordable and middle income housing. And so these have been very effective programs. Could they be better? Sure, every program can be better. Every program can be smarter. But we need to be really careful not to throw out the baby with the bathwater in Texas and elsewhere, and making sure these programs continue to be examples for the rest of the country. And ultimately, what they should result in is more supply at these more moderate and lower income price levels, rent levels. That's what the goalpost should be. And the more we change things, the more ultimately we're going to undermine the original intent. All right, let's get back to rental housing trivia. This week's question was, how many affordable housing units have expiring tax credits between now and 2030? We give you 4 choices: 152,000, 252,000, 352,000, or 1,520,000. So what do you think the answer is? These are LIHTC affordable housing units with expiring tax credits. The answer is it's C, about 352,000 units. This data comes from the Public and Affordable Housing Research Corporation from a recent article by the Associated Press. So this is a real policy dilemma. I kind of alluded to this a little bit earlier, but these tax credits and affordability requirements typically last about 30 years. And seeing that we're nearing that 30 year plus mark for that first wave of LIHTC properties, low income housing tax credit, we have a lot of properties that are reaching that 30-year threshold. But a lot of them are going to require some capital infusion to preserve them and handle deferred maintenance, et cetera. The roofs, the HVAC systems, everything else is not cheap. And that typically means one of 2 unattractive choices. Ignore the maintenance, let these units further deteriorate, but preserve the affordable rents. And that's a lot we've seen happen in a lot of rent control and public housing, particularly in places like New York. Or update the property, but raise rents to pay for it. So, it's easy to point fingers, but these are more complicated issues than a lot of headlines want to acknowledge. And really, to accomplish the main goal, we have to figure out ways to really ensure that we're doing both, right? Because these buildings do need a capital infusion, and so in some cases, we're going to see these properties that the rents have to be brought back to market to make sure that they're safe and updated and taking care of those deferred maintenance needs. But if we have a public-private partnership program in place, of which we have some, but just not enough, that's going to make it a lot easier. So let's focus more on preserving not only rent affordability, but also the buildings themselves. All right, so next up, let's enter the interview portion of today's podcast. I'll be joined by Alecia Hill, the VP for Impact Investing at FCP. She's also, here's a little fun fact, the reigning champion of the NMHC Young Guns pitch competition for emerging leaders. I had the honor earlier this year being one of the judges for that competition, and Alecia really stood out with her pitch for affordable housing investment in Indianapolis. She's a real thought leader in the institutional affordable housing space. So let's jump into the interview. All right, welcome back. And now we're going to enter the interview portion of today's podcast. And I'm thrilled to welcome in my friend Alecia Hill, Vice President for Impact Investing at FCP. So thank you so much for joining us today.
Jay, thanks for having me. Really great to be here.
All right, I'm thrilled to talk to you about, we have some shared interests. And I want to start with this. You've become a real leading voice on institutional investment in affordable and attainable housing. You played a key role in several industry groups. I've seen you around the circuit lately and also lecturing universities. You won NMHC's annual Young Guns investment pitch contest while pitching an affordable housing investment case. So tell us about your journey into this space, because I know it wasn't a traditional path. And I'd love for you to share the story of how you get into this and develop real passion and expertise for it.
Absolutely. So real estate is my second act. Today I can look back at it and say, I've got a sense of purpose about the industry. I'm very committed to it. And the through line makes perfect sense. It did not feel that way through the career transition at all. But I started out with a focus on the performing arts. That was really the career path I had my heart set on as a young person. I was a ballet dancer, was very committed to that, went to college in New York, really pursued that. And over the course of working as a creative, that evolved into voice acting and becoming a student of theater. And really, the arts industry is really where I first began to develop my own personal thesis around the relationship between a mission imperative and business. The arts is very challenging. There's oftentimes very low probability of success. There's often a lot of instability, relies heavily on patronage, nonprofit organizations, philanthropy. And so, as a professional, whatever role you have and whatever your medium is, you get some experience with that. So lots of survival jobs, lots of innovation and creating work with peers outside of sort of our typical sort of gig or production, whatever the case may be. And so I really just started asking myself a lot of questions around demand. What really makes this industry work financially? Where's the capital coming from? How is that distributed in terms of projects and opportunities? And how does that impact me as someone who's really relying on access to that? So just a lot of personal questions. Getting older, there's a shelf life, obviously, to that kind of work. And then really deciding, hey, I want to go back to school and figure out what's next for me. And so I knew that I was very committed to having a sense of purpose about my work. If it doesn't align with my values or interests, I'm just not going to stick with it. And then also being very interested in being able to exert influence with capital. And so that was sort of my first discovery into what is impact investing. I really started there. Real estate has become the right vehicle for me. I think really, only in the last few years would I say, okay, I'm a real estate person first and not necessarily an impact investing person first. So that's really how the journey got started. Was very fortunate to, at the same time, build a toolkit of public policy expertise and comfortability, community development finance, private equity, did a lot of that through graduate work, and then also having some wonderful executive sponsorship and mentorship in some really key roles. I worked at Enterprise, which is the CDFI, initially got exposure to much more bespoke, nuanced, and very niche affordable housing related work, and got to really work on programs and policies as well as investment executions that at the same time were being developed live overall. And so through that experience, decided, hey, this is what I want to do. Turns out I picked the most difficult, in my opinion, areas of the real estate business from an investment standpoint. So sharp learning curve, but you build a lot of conviction and learn on your feet throughout the process. So that's kind of the high level story. And, as I said today, I'm like, oh, this actually makes perfect sense. But at the time, you just had to kind of keep going forward and be comfortable with not sure where that was going to land.
Well, I love the story to speak. I'm glad you shared it. Thank you for doing that, because while on the surface, it seems like two entirely different careers, going from the arts to institutional real estate. You've really found a way to bridge them together and develop not just a job, but a real passion for what you do. And I really admire that. So let me ask you, getting into the weeds a little bit more on real estate, we're seeing, I've been in this business for 15, 16 years. And over this time period, we've seen more and more institutional interest in affordable and attainable housing. But in this cycle right now, in this moment, here we are in late 2024,
it doesn't make, just because we want to invest in this stuff doesn't make it any easier for these deals to pencil out, even with subsidies in many cases. So as someone who's looking at this stuff every day, tell us what works in this environment. Are there certain deal types, programs, vintages, markets that work better than others right now?
Yeah, I mean, you make a great point, and it's an excellent question. Never before has the business case for affordable and attainable housing as an institutional, compelling, investable segment been stronger. It's a very strong business case. We've got very compelling data, which I know you've shared here before, around credit quality, long-term outperformance, particularly across down cycles. Also thinking about long-term appreciation, and in spite of all of those positives, it's still really challenging to get deals done. And I would say, in terms of what's really working right now, we're all existing, even if you're focused on the affordable side, in the same market environment and the impact that that has had on feasibility, particularly over the last 12 to 18 months. So seeing a lot of focus on public-private partnerships, as it relates to affordable and attainable housing, I really see that as a bright spot for that part of the multifamily industry, because it really is marrying the public sector's emphasis and interest around really solving the affordable housing crisis, but also it's enabling and incentivizing the private sector, whether you're a developer or more of an owner operator that's acquiring, to really focus on how can we sync up these priorities to get deals done. So seeing executions with property tax exemption in exchange for a set aside at varying AMI levels, seeing folks get creative with low cost debt solutions or funds that may exist and be held within a public jurisdiction, but is specifically focused on supporting low-income housing tax credit deals to provide some gap financing. So housing trust funds are another solution. So I would say, kind of that public-private partnership execution, irrespective of whether it's capital A or more of a naturally occurring or attainable product, is where you're seeing a lot of success. In part, I think that's because it tends to, particularly as it relates to more of the attainable, it tends to support feasibility for a more institutional quality product. So, from an investor standpoint, as far as that interest is concerned, really interested in more of an institutional quality product type versus some of the older vintage product that has other CapEx and other concerns. So I would say that that's really a common theme overall. With respect to programs, the LIHTC program has a tremendous benefit as it relates to supporting this space, but those deals take a lot of time. And they're also heavily focused on either new construction or a substantial level of renovation that still requires very layered financing. So I would say, seeing LIHTC opportunity, it is out there, and seeing some public sector commitment to support those deals in ways that are possible, which might mean, hey, we're going to allow for some by right tax exemption for nonprofit participation in deals that are focusing on a LIHTC execution or resyndication. But it's very challenging overall.
Yep, absolutely. So, and I want to come back to the topic you mentioned, just touched on, which is the older vintages, because that's a really important one, and one that in our previous podcast talked a little about with David Brickman, the former Freddie CEO. But first, and you touched on this a little bit already, but tell me, what just doesn't work right now within the affordable, attainable space?
Yeah. So what really doesn't work are, assets that have been capital starved or otherwise have faced so much operational deterioration that you're really butting up against the ability to execute towards your affordability mandate, which, if it's capital A, that may be a deed restriction and very prescribed, so you have to do it. And then in other instances, for folks that have strategies that are really targeting more of a long-term preservation approach, in those instances, many of us have, an emphasis on sponsor-initiated affordability overall. And there are a variety of reasons as to why that's important, both from a securing really attractive financing to do those deals at more favorable terms, in addition to just mission imperatives that are part of the strategy. So I think really what doesn't work is to try to have a level of repositioning that's just not supportable without creating the conditions by which you either increase the risk that's associated with the business plan that you have in mind for an affordable or attainable preservation focused execution, or conversely, you've got something where it just doesn't pencil out right. So with new development, for example, new development is challenging across the board. But if you layer on this affordable or attainable aspect, depending on how you define that, that can really determine whether or not it's possible to really execute upon that. And I would just add on the new supply and new development front, you do see a huge emphasis on that, particularly in certain geographies and jurisdictions where the public sector is really driving that commitment. But you do have to balance what level of affordability is needed and are they mandating or asking for relative to what can you actually build to support that. So it's definitely, I wouldn't say there's nothing that doesn't work. There's always, exceptions, but there's some themes for sure. And those are the ones I would call out.
Yeah, so let's dig on that a little bit deeper because you allude to something that I think's an emerging problem that doesn't get enough focus outside of our industry, which is that I think sometimes in this movement to create more affordable housing and deeper affordable housing, we sometimes are shifting toward things that just aren't working as well in terms of volume. So getting a little bit of details here, we're seeing this trend in states across the country, and it's red and blue, honestly, from New York to Texas, and really trying to crack down on incentives and subsidies for affordable housing, really limit what qualifies as a quote unquote affordable in terms of AMI. And in fairness, while we all want to root out any abuses, I worry there's so much focus on developer profits that it's the focus on profits is more important than the focus on creating supply. And, for example, as you know, New York's going to end up with less supply because they replaced the 421A program with a less attractive program. Texas is facing resistance around its PFC program, even after some reform already. So am I right to be concerned about the potential for impacts of reduced supply? And do you worry about these things too, or am I off base?
Yeah. So, I think it's nuanced. I do worry about what I worry about really is overcorrection, right? We have a huge problem as it relates to affordability. I do understand and appreciate that the public sector is really their customer is not necessarily the real estate industry. That's a bit nuanced as property tax revenue supports a lot of what's needed in the public realm. But sort of on brand, their customer is really their constituents. And so the desire to try to solve for this significant issue that's impacting everyone, I appreciate that. But what does concern me, as you alluded to, I would frame it up as overcorrection. And so as a result, you've got these very catalytic programs. You noted the 421A, which has gone through various iterations over the years. And was recently sunset with a program that has come behind, which is much more nuanced and complex. And I think most folks who have started to really dig into that, like you, have noted that not really clear if this is going to actually move us along and really may be an impediment in some ways. And then you talked about also some of the Texas programs. So what I would say is it's something to be mindful of and to be concerned about. But I think there's also something that we on the private side can do to really try to help smooth the path. So part of that is advocacy and education as it relates to, hey, here's what actually makes deals work. Prior to the work that I do now, I spent a lot of time trying to execute through the Opportunity Zone program, which had a mission sort of imperative with respect to investing in underinvested areas. And, something that I learned through that experience and that many folks learned to try to execute through that is from a practitioner standpoint, there were aspects of that program in terms of how it was structured that were an impediment to be able to fulfill both the commercial and impact-oriented goals that were in mind. And I think that happens frequently with policy. And so I think, to your point, for some of these programs, what we can do is really understand that affordability is needed across all income cohorts. We've got great data, most recently out of Harvard that is telling us that missing middle, that 60 to 100% AMI is experiencing cost burden at a much more significant rate, which in my mind, what that translates to is if I think about all income levels as a distribution, the midsection of the distribution is starting to encompass many more income levels. And so as a result, we really do have to find a way to partner with the public sector to get to programs that actually work. And I think we can lean into that on the private side by trying to be a part of that innovation and also really educating on, hey, this is why this doesn't work for us overall. So it's a great point that you raise. I don't have a crystal ball, of course, but for example, when I think about New York, there is such a tremendous amount of affordable housing that is needed there and that already exists in the existing stock. I think that as these programs continue to move forward and are not working, we'll continue to see iteration of ways to improve because we really have no other choice. And I think places in the Southeast and Sun Belt that are increasingly facing what feel like new challenges around affordability over the last few years are also going to start to find that, while these programs may have some NIMBY pushback or other issues, we're going to have to keep iterating. We really don't have a choice. So I'm in some ways encouraged by that because I do think that is where, over time we can continue to iterate. But in the meantime, we are not helping our supply challenges.
Absolutely. And that's very well said. And, I hope as we iterate on these things, we just have to make sure that developers who actually want to build affordable housing are part of those conversations, because what's really frustrating, I think, for the development community is when you have elected officials who are telling them what they need to make it work, as opposed to having a conversation about what's mutually workable. And so, hopefully we could get to that middle ground. Let me ask you about, excuse me, another related topic. And this is one that maybe one of the issues I'm most concerned about. And that's these expiring tax credits of some of these early LIHTC multifamily properties. People talk about preservation of affordable housing, but they sometimes forget there are two aspects, in my view, of preservation. One is preserving affordable rents. The other is preserving the building, the units physically. And these are aging properties, at this point, 30 plus years old, or will be 30 plus years old, that require capital infusion, which makes it difficult to preserve affordability without new subsidies. And so, basically investors put in this choice of, hey, if you renovate the property without the tax credits, you're going to have to raise the rents to pay for it. Then you get risk of being charged, called a gentrifier. If you don't, then the properties age further and you get risk being called a absentee landlord. And so you mentioned earlier that these projects with heavy CapEx needs don't really fit in the institutional buy box right now. So I really want to kind of get in, I guess, from both an investment perspective, also a policy perspective. How do you approach these kinds of deals, and what can be done to preserve affordability while taking care of, the deferred maintenance, other CapEx needs?
Yeah. So, bar none, the LIHTC program has the most meaningful impact on creating and preserving units for the lowest income cohorts. And so I think it is a critically piece of stock we have to save. We also have to continue to make new, which is challenging and very timely and expensive. And I think also, just want to touch on one point that you mentioned, which is while the program has reached that sort of first 30-year benchmark, so many of those initial tax credit assets are in that place where they're at risk of expiring in terms of their restrictions, not all of those assets were new. So you have folks that may have acquired a 60s deal and in 2000 put in low-income housing tax credits, and they would have been able to put in some capital infusion as a part of that execution, but you still have a 70s deal that has a 15, 30 LORA, however long the LORA may be. So I do think it's important, to your point, that a lot of this affordable stock, whether it's LIHTC or NOAA, the average age is significantly older. So that is a huge concern. I think from a preservation standpoint, we're not going to be able to preserve everything, right? Like there is a certain level of obsolescence where the repositioning that's required will require a capital infusion that can only be done with subsidy or with a resyndication of tax credits if it's an existing tax credit deal, or potentially taking something that is free market but really needs a significant CapEx lift and using that as a tool. And obviously there are implications, to your point, around a repositioning of that level. But what I would say is, with respect to preserving these deals from a capital standpoint, some really innovative approaches that can be taken, and I'll also speak to ones that I hope for, but are not yet proven out. So one, in the public sector, if there's a way to get a tax exemption, for example, for a deal that is expiring, LIHTC, and by making a commitment to preserving rents that are similar or that still are directionally going towards that low-income housing segment, which for me, I would define as sub 80% AMI, maybe you're not able to maintain the same level of affordability as was instituted during the initial LIHTC phase, but you can still maintain, depending on the location and the level of additional financial support that could be executed through some type of public sector subsidy, or just recognition that we want to preserve this and therefore we're willing to provide, an exemption or what have you. So that's one scenario. Have also seen some situations where you, again, through the public-private partnership segment, where certain jurisdictions will provide either grant support or subsidy that's focused on CapEx improvements. So there's a commitment to that as well. You're also seeing, a focus on wanting to make sure that existing deals that are out there today can have capital reinvested back in. I think one good example, complex and doesn't necessarily work everywhere, but the RAD program and some of the NYCHA PAC deals that have been done in New York around public housing that have tremendous deferred maintenance issues, where by engaging the private sector and really creating more of a public-private partnership model, that folks are finding success there. But those are relatively complex demonstrations, and they don't necessarily work in every market because they are relying, to your point, on subsidy in some form, whether that be through some type of contract that supports rental assistance, so that you can actually put in that level of capital investment and be able to maintain rents at a level that actually make the deal feasible from the developer standpoint. So it is certainly a challenge to do overall. And, as I said, there will be some instances where it may be more challenging than is possible. What I do hope for, though, which, we'll see how this plays out, is when you think about something like the greenhouse gas reduction funds and some of these other commitments of significant dollars, whether it be through transportation-oriented initiatives or other appropriations that are trying to focus on other strategies, environmental, whatever the case may be, housing has been included in some of those. So to the extent there is a pathway to being able to implement improvements that have good implications for an existing property, and that can also potentially offset some of the other costs or blend down the rates of the overall financing used to complete all of the improvements, because you've got some that are eligible for a very specific funding source, that could be very interesting. All of this is obviously very new. And so, at least for me personally, I have not seen a demonstration with any of these as of yet, or a clear sense of how they'll actually administer all of those funds. We'll see, what happens in 25, but that's an area where maybe there can be some emphasis and focus to try and really address some of what you spoke to. Because I do know through those initiatives, there is a additional incentive if you're focusing on low-income housing in particular. So those are just kind of a few of the things that I've seen, but it's a huge thing to be focused on. And I appreciate that a lot of owners, including, FCP as well, we also think about what we can do to just improve asset quality in our business plans and different ways to find efficiency in operations and in other efficiency projects as it relates to sustainability, which net has some level of benefit to making sure that these deals can work and we can operate them to a level that is within line with best practices.
Oh, great point. And I love that. And I hope that there's more kind of policy or political and social awareness around these topics, because what we don't want to see is just the continued erosion of these buildings like we've seen occur in places like New York and Los Angeles, San Francisco, among some of the older properties out there that are affordable. So related question, we're recording this a few days before the election. We don't know how it's going to turn out yet. This will probably come out a couple days after Election Day. So whatever happens, let's say that next president's transition team calls you up and says, hey, we're starting a task force on rental housing policy. We want to focus on affordability and supply. We want you to be part of this. What types of policies would you propose, or adding or adjusting, to help increase supply, particularly for low and moderate income renters?
Yeah, so I think, first and foremost, we need to make sure that the tools that we have are as efficient as possible. I think there is a level of attention to the programs that we have where we can really focus on that. As it relates to the tax credit program, the Tax Credit Improvement Act that had some momentum earlier this year, which that has now since slowed down. Let's make sure that we don't lose any tools. So that I would say that's first and foremost. I think also there's this paradigm that we have, I think, in the policy sector as it relates to public policy at the federal level versus at the local level. And a lot of what we need as practitioners really gets administered and really sort of adjudicated from and administrated at the local level. And so if you're a national owner operator, you're not necessarily going to face the same regime as far as structure, program, potential asks in one market as in another. So that makes it really hard to be able to do that. So on the one hand, I do think local jurisdictions are best positioned to determine what it is that they need. On the other hand, I think sort of a federal framing, if you will, around tools that can be deployed locally, whether that's funding solutions, whether that's helping to ensure that, look, if we've got programs that are working in Texas, for example, or working in New York, we need to try to sync up systematically some of the definitions that we use, trying to make sure that we can find alignment, because it's very difficult for developers to scale their operations, their portfolios, and really have more commitment to the space if they're not incentivized to do so, or if it's significantly more challenging from one location to another. And then the last thing I would say is the cost to build affordable housing is tremendous. It really is tremendous. And if you were to build the same product, but have it not necessarily run through some of the existing prescribed affordable housing models, the cost to build that same product would be significantly different. And
Right.
so I think, as a matter of course, we have to really understand what is really driving that expense. And a lot of it is inefficiency. So those are some things I would call out. But I think for me overall, it's not any one policy that I would say, hey, we need to do this. I would really want to first make sure we need to tackle the policies, the tools that we have, and make sure that they are as efficient as possible. I think that's really an important case. There has been some discussion around a middle income housing tax credit concept, in prior iterations. I think those ideas are interesting. What's important to me, though, is that we don't recreate challenges and inefficiencies we have through existing models in new ones. So just trying to really understand that so that we can incent other capital sources and intermediaries into this space. I think that's an important part.
Absolutely. All one fantastic points. And your comments remind me of a previous conversation I had with Hugh Frater, former Fannie CEO. And he said, we got to keep it simple and reform some of the programs we have, to your point. So fully agree with what you're saying there. All right. So I want to wrap it up with this. Affordable housing, you've touched on this a little bit. It's so complex and yet so simple another way, which is we just need housing that's affordable. And so that kind of feeds into this question. What's the biggest misconception about affordable housing today among both investors you work with and also the general public?
Yeah. So I think first and foremost, right, affordability is a relative measure. It's really benchmarked relative to, at least for our industry, where you live, what the incomes are there, lots of other inputs. And I think something that really is a misconception is affordable does not necessarily mean low income. And the tenant base that we sort of ascribe to capital A affordable housing is often very similar to what you're going to see in naturally occurring conventional deals of a certain age and quality and condition. And so as a result of that, I think it's important to be reminded that many of the tenant demographics that really fall within this segment where there's real demand, they don't necessarily self-identify as low income. And I think we need to really focus on the merits of this part of multifamily from a supply, demand, and balance perspective, focus on all the great data that we have around the performance long-term and the lower volatility long-term, and really try to reframe what the actual risk is within this particular segment to make sure that we are really pricing it correctly. Because at the end of the day, what's going to allow us to, at least in my opinion, to really be able to be successful in making a dent into solving the need that we have are a couple of things. So one, first and foremost, preservation is a form of creating new supply. So we need to be focused on that and making that feasible and possible. Two, we also need to be focused on getting as much capital into the industry as we can. And the pathway to doing that, I believe, is to really sort of help ourselves along by having some alignment around definitions, alignment around the risk profile as it relates to this space. And that's tricky overall, because that really is dependent upon the platform, their strategy, what the business plan is. But I do think there's both an education opportunity as we really start to have a much more institutionalized affordable housing segment, but also just really focusing on the fact that there's some real fundamental based merit here in what we're doing, and really trying to anchor around that thesis so we can get more support across the board. I would also say, as it relates to the operator side, something that I hear very frequently in our industry is we've got kind of conventional and we've got affordable, and we even kind of bifurcate that way in terms of the financing. Right? There's your conventional team and your affordable team. And, I would submit to you my personal view. There are many folks who are in the conventional space of multifamily who are sitting squarely within the realm of affordable housing. Definitionally, that is who they are targeting as a demographic. The markets that they're operating within, generally speaking, market is in that kind of HUD-based low and moderate income framing. And so whether you choose to execute a business plan where affordability is a part of the mission and the investment mandate and strategy, or if it just happens to be a condition of where you're executing or the type of customer that you support, it's ultimately all of our problem to address this, either as a risk mitigation point or as a mission imperative. And so I think that's very encouraging, because we can all be incentivized to try to find some efficiency here and to align around, really the merits of this particular segment so that we can myth bust where necessary.
Absolutely. Those are all great points. Well, hey, I've learned a lot from getting to talk with you today. I'm sure our viewers enjoyed it as well. So thanks for making the time, and appreciate all your insights.
Absolutely. Thanks so much for having me, Jay.
I'll tell you what, even if no one else listened to these interviews, and thankfully many of you do, but even if you didn't, I would still do them because I learned so much from talking to Smart Hill. I love picking the brains of brilliant people like Alecia. And thankfully, we have more good conversations coming up soon. Got a conversation coming up with John Drockman of Waterford Property Company, and they're a group that invests in Southern California and in Texas. Very different markets to invest in and to operate in. Those are two markets. So we're talking to John about the differences and what brought him into Texas, being from California, why they still believe in California. So that'll be a fun conversation. I was talking to him about, his nickname is Dr. Doom, and so we talk to him what he thinks about today's market and where we are in the cycle. And then another really good conversation coming up will be with Fred Twomey. And Fred is formerly Equity Residential, formerly Imitation Homes. And so he's been in multifamily side, the SFR side, and leadership positions, and really one of the big leaders over the last few decades in the maturation of both multifamily and SFR as an institutional investment class. So we're talking to him about some old Sam Zell stories, as well as the what it's like to go from multifamily to single family rentals, and how he sees these sectors coming together more over the coming years. So those will both be great conversations. Stay with us these next few weeks for both of those. That's going to wrap us up for episode 11. Thank you to everyone for spending part of your day with us. Really appreciate it. Keep that feedback coming. Thank you.